Good morning, everyone. It's Michael Naidrich, one of the founding partners here at AmeriVet Securities. Today, in our continuing series of adding value to our client base, we have one of our in-house new hires, Greg Faranello. Greg, welcome.
Mike.
Greg is all thing rates and rates commentary, and we have the two-day policy meeting amongst us today, and we wanted to get some ideas and thoughts on what you're seeing and what you're thinking, and welcome.
Thank you.
Hope to be doing this often with you. And
Good.
This is going to be great insight to our client base. So
right.
What are you thinking headed into the couple of days here?
So clearly this is, I think, one of the most watched and anticipated Fed meetings that we've had in a long time. And just to set the stage a little bit, when you look at the transformation with regard to Fed policy and pricing from the fall of last year through the end of last year, the Fed pivot to where we are today, we've gone from a scenario where we had 4 hikes priced in at one point and the market feeling very comfortable that they were right in that direction, to now having close to 3 easings priced in, right? So the market has gone through this transformation period. And there are a lot of different factors as to why that is, and we'll talk about that a little bit. But we have a scenario where I think initially the Fed was sort of leading the way with these methodical tightenings, normalization of policy coming out of the global financial crisis, coming off of zero interest rate policy, and the market was following the Fed with that. From there, now we have a scenario post-pivot where the Fed seems to be chasing the market. So the pendulum, as I call it, and my theme for this year has been market expectations versus Fed intentions. In other words, what does the Fed want versus what the market wants? And they're really two different things. We're going to find out tomorrow, I think, which one is right at this point. But the Fed now is in a position, I think, to dictate to the market what it wants from here. So in that process of the pendulum swinging back and forth, the Fed seems to have lost a little bit of control in terms of where it wants the market. And I think we're going to find out what the Fed wants tomorrow.
So let's talk about that. What is your expectation tomorrow? You watch CNBC or some of the other outlets, and you're getting sort of all over the place, sort of, some people think they're going to cut, some people think they're going to stay. I know there's a very interesting middle part of the game. I just read your piece yesterday on the 3 Ps, right? Pricing, Powell, and POTUS, and we can get into that a little bit. Very interesting read on LinkedIn or AmeriVet's website for those of you watching. What is your expectation for tomorrow?
So my expectation for tomorrow is that the Fed will signal that lower rates are coming. And that really has been our core. That has been our core scenario now for quite some time. When you look at the work that the Fed has done, when you look at the communication that's been out there, clearly to me the groundwork is being laid for lower rates. And it's not just the Fed. The ECB came out this morning. They're signaling more liquidity to come. Global central banks really around the world now have shifted from a stance of tightening and pulling back to providing liquidity. The ECB included. Not too long ago, they were going to normalize by the end of this year and tighten. Now they're talking about liquidity. So it's been a dramatic shift. But what I expect from the Fed tomorrow is for the Fed to signal that lower rates are more than likely to come. But more importantly, to echo what Chairman Powell and Vice Chair Clarita have said recently, that the Fed will do what is necessary to sustain the recovery at the end of the day. So the data does matter. The data has weakened. The question is, has the data weakened enough for the Fed to come in and actually ease tomorrow? I think that's an unlikely scenario, although we are priced for a small chance that the Fed could ease tomorrow. And I think...
Where do you put that, about 20%?
It's around 20%. So it's unlikely, but given what we're hearing lately, given what we've seen out of the ECB, what we're seeing from the other central banks, it's not off the table. And I think the market is saying, look, there's a small chance, but it's not likely. So I do think the Fed will be dovish. We're priced now for a cut in July. We're priced for a cut in September, almost 100% for each, and a little bit more as we head toward the end of this year. But my baseline scenario has been a Fed funds rate 50 to 100 basis points lower, but by the end of 2020.
So here's a question for you. I think Chairman Powell's in an interesting spot because, he can say we'll cut down the road, right? But if he was to cut tomorrow, some would say there might have been some pressures put on him from the president. And reading your piece and talking to you earlier this morning, that's got to be a little bit of a tricky situation for him on how he handles this, right? Because if he doesn't cut tomorrow, if he doesn't ease tomorrow, he then can say, he's still his own independent person. There will be a perception if he eases tomorrow that the pressure of the president kind of got to him a little bit. How do you read those tea leaves?
So that's a great point. We do have the G20 meeting. Clearly, the situation with China, the tariff situation, is a critical component, really, of what's going on here globally. It's not just affecting the U.S., it's affecting many other countries. So the dynamic between the president and the chair has really been there. And if you see what happened in December of 2018 when the Fed made that one final controversial hike,
Yep.
which most market participants agree now was probably overdoing it a little too much, to me, there was some politics in there. That was Powell saying a little bit like, I hear you, but we're going to do things on our own terms. I do view tomorrow to have a little bit of that same flavor. The rhetoric and the outcry for lower rates coming out of the administration has clearly, it's increased, and probably rightly so, right? Currencies are in play. Currencies across the globe are weakening relative to the dollar. Tariff situations, exports, these things do matter. So from the administration's perspective, there is an understanding as to why they would want rates to be lower right now. But on the flip side, the good activity that we've seen in the U.S. from 2016 to 2018 also gave the Fed a chance to normalize policy off of zero interest rate policy, unlike some of our global counterparts. And the end result now is, as the chorus grows from the ECB and some of these other countries, their rates are going negative and our rates still remain positive, right? So I like the edge that the Fed has right here and now. I think what they did from 2016 to 2018 was constructive. We still have positive real yields versus negative nominal to real yields on a global basis. So for me, I think the Fed has an opportunity to speak dovishly to the market. They've already said, look, we're here if the data warrants and the market needs us, but I still think they're in a position to hold pat and remain somewhat independent.
Watching it, this is the tone to be set for moving forward. This is, I think, one of the most anticipated Fed meetings in recent time. I think this is an important day for the markets, and you're right, valuations are high, and coming off the hockey stick bounce of December, it'll be interesting to see how the markets react. I know this, usually they react wrong first, but that's a historical perspective. Well, listen, welcome to the firm. We're really excited to have you. I think your rates commentary is going to be very important to our clients, and if anyone watching here today would like to speak to Greg or have him come visit, we're happy to have him here. We are very proud to have him join the firm, as we are committed to continually adding value to our client base. So we wish everyone a good day, and we'll see you next time.